next up, I get to introduce my main squeeze, my partner in crime over here, Javier Haas. Get your butt over here. How are you, man? You all right?
I'm doing great, doing very, very, very well. Learning a lot today, hearing from some of the best voices in the industry, if not the best. Great day. Great day today, great day yesterday, and great
It
panel.
is. It is. This is one of my favorite panels that we run, by the way. And I'm going to shut up and get out of the way. It's good to see all of you. I'll say hi again at the end, but these are some of the top voices in the industry. So, Javi, take it away, pal.
Indeed. Thank you. Well, thank you all for joining us. This is a great lineup. I am very excited to see the screen populate. Today, we'll be talking cannabis investments with Todd Harrison, founding partner and chief investment officer at CB1 Capital Management, Sean Stiefel, CEO at Navy Capital, Emily Paxia, founding partner and managing partner at Poseidon, and John Licorizzo, CEO of Focus Growth Asset Management. Ladies, gentlemen, thank you so much for joining us. And let's do a brief round of intros. I'll just go in order as I see you on the screen. Emily, do you want to go first?
Sure. Thank you so much for having us, Javier, and to the entire Benzinga team. My name is Emily, co-founder of Poseidon. We have 3 funds now dedicated to investing in the industry. We've been doing so since January 2014, and we have 7 syndicated direct vehicles and another strategy coming, which I'll be excited about when we launch it. But lots of things going on. It's been exciting to see how this industry has evolved over the tenure of our investing into the space, and the velocity of change that we're witnessing in a productive direction, aside from some of the banking setbacks of the last few months. I'm pretty excited about where things are headed. So thanks for having us.
It's a pleasure. John?
Sure. Thanks. Thanks again, Javier, and to everyone on Benzinga. It's a pleasure to be on this panel. Started Focus Growth Asset Management in early 2020. We bring together operating, investing, advising, financing, and legal and regulatory expertise in the cannabis industry. A team of 13 people, and we look to provide capital and strategic or financial advice to companies in the industry. So we've created a platform to source, analyze, underwrite, structure, document, and agent investments. We raised our first fund, FGCP1, earlier this year. We had a final close of $163 million, and we've deployed about half of that capital. And we have a very flexible mandate, right? We really start with the people, really understand the assets and the operating plans for the company, and then we could be really flexible and creative in terms of how we structure the investment to help the company maximize probability for success. So I'm excited to be here, and thanks again for having me.
Thank you. Sean?
Sean Stiefel, founder of Navy Capital. Navy Capital is a $400 million SEC-registered hedge fund. We've been investing in cannabis since 2017. We are a hybrid structure, meaning that we invest in both public equities and private equities, and we will invest in any and everything all over the world.
Great. And Todd?
Yep. Hi, and thank you for having me. It's a pleasure to be here and to be in such good company. Todd Harrison, I've got 30 some odd years on Wall Street, started at Morgan Stanley, moved up on the buy side, was president of Kramer Berkowitz back in the day. And had left Wall Street until I saw the opportunity in cannabis. I've been studying the space for over a decade now, and really asymmetric opportunity through our lens. The CB1 Wellness Fund is a global mandate. We're pretty focused on the U.S. opportunity right now, but certainly excited for the 3.0 opportunity on the horizon, which I hope we'll speak to. But thank you for having us.
Indeed, we will talk about that very, very, very soon. But, let's start at the beginning. Capital is flowing back into the industry. According to data out of Viridian Capital Advisors, the first 5 months of 2021 saw more than $6.6 billion in deals. And, we've seen some very big deals, by the way, and we'll get to that. But, $6.6 billion in deals this year, up from $2.33 billion we saw last year in the first 5 months. What do you think is driving this renewed interest, right? Any particular trends that you see emerging? And for this one, anyone who wants to go first can take.
I mean, I'll just start by saying I feel like it's because the business models are proving out, and specifically in the US with the MSOs, they're demonstrating incredible growth. great EBITDA margins, and I think that the business case is there. So institutional capital is seeing this. They're seeing it more as a consumer category, which instead of its own kind of siloed little basket, it's now part of a high growth consumer space. And I think that's a really great way to think about it, especially in the United States. So that's my take on why capital is starting to flow to it.
I think a lot of it is the timing, given what happened with the November election and the Georgia Senate runoff. You had a ton of excitement and a lot of capital flow in sort of early Q1. I think a lot of that capital is dried up, frankly, and you saw a flood, and then now you're in a bit of a dry spell. But we are in a favorable political landscape theoretically, and that's why the capital came in.
Yeah, and I would just, to echo that, I think certainly that played a part. To look back and, a year ago, a little over a year ago, entering that year, Pershing had pulled the plug on all the custodians. So hedge funds had to sell all of their cannabis stocks into the pandemic. And this was before the pandemic. But once the pandemic arrived, once that essential status was created, and once really the breadth and the depth of the pandemic really became better understood, and the need for tax revenues and jobs and the state level adoption that was going to drive that, I think, was the underpinning. And for us, that's the underpinning of the U.S. opportunity, is the state level adoption. But certainly the Black Lives Matter, the social justice piece, illuminated the war on drugs for what it is. And of course, in November, as Sean said, the 5 states, both red and blue, and then Schumer in January, although certainly I think people getting caught up on what's going to come and when. By our lens, state level adoption is really the driver. Fundamentals are getting better while the stock prices, as Sean said, are having some liquidity issues. But it is, I think for those with the right time horizon and risk profile, it is setting up as an asymmetric opportunity in a world of very expensive assets.
John, anything you'd like to add there?
Nothing to add.
So, one of the things I was actually thinking about here is, do you see any events in the near future driving this interest as well? Like specific events, Todd, you just mentioned some of these and speculation around, will it happen? Will it not happen? Are you talking about the MORE Act, safe banking, more general legalization, international moves? What do you think, what events do you see in the midterm horizon driving this interest? Todd, you're muted.
Pardon me, I'm sorry. I think a lot of people are waiting for Chuck Schumer's draft of his comprehensive overhaul, but the word on the street is that he doesn't have 50, much less 60 votes, and that he's going to sort of back into safe sometime later this year. The market doesn't want to hear that. The market's looking at, when can these things uplist? And again, there's a lot of shiny liquid objects floating around that are attracting attention. But I think people are waiting for that, and I think they're looking in the wrong direction because, traders are voting in the short term, but investors should be weighing this opportunity with a long-term lens in our view. And these are some pretty attractive prices. You're looking down 35% for an industry since January after, an incredible year-over-year gain. I could argue that's pretty healthy, and the sentiment flipping the way it has, I could argue is healthy too. We just need that spark.
I think there's a couple tangible things that we can look for that beyond sort of what comes out of the federal government that would be great. The first is obviously New York and New Jersey actually rolling out adult use. Yeah. When you have more and more institutions and money managers going home at night and seeing that would obviously be fantastic. And then the second, and I think this is kind of a sleeper prediction for the year, is you'll see sort of a non-cannabis company, alcohol or tobacco, make an investment in the United States, which will really kind of set things off again. I think that's coming, and we don't necessarily need SAFE or more initially to get people back in the space. I think any one of those could really get things going. Yeah.
Can I just add one thing, please, and on the topic, and I'll stop. I think the realization in Washington is that none of these social justice initiatives, which is the most politically tenable approach to this issue, have really a shot without banking. Right. And I think that light bulb recently went off when they're realizing that without banking is not a big business issue necessarily, but it's really an equity issue, an equitable issue for all the stakeholders that they hope to, come into this space. So I think that mindset is starting to move through DC now.
I think, this has been a catalyst-driven industry since we've been in it. And in fact, I mean, it was a catalyst that got us into it was when we realized that
Yeah.
Colorado had voted to have adult use was in 2012, and that's when we started taking it very seriously. But I think that, going back to what I was saying about the fundamentals of these companies, in the previous catalyst-driven moments, I don't think that the businesses were there to back up the thesis of investing in cannabis, but I do feel that today we're in a completely different landscape. And so I'm hopeful that if we do have these catalyst moments, and I think Sean articulated a great one, Todd, Sean, I think back to when Constellation invested in Canopy was a huge catalyst moment. But I don't think the readiness of the businesses was there. I think it is now. So I'm hoping that the next round of catalysts we see kind of more right size the market, and then we can really get the liquidity and cash flowing into the space that it deserves, because it's an excellent industry, really.
Yeah, it'll be interesting to see how, if safe banking passes, how it paves the way for a greater capital markets opening up to the industries. But from what I've observed in cannabis over the last couple of years, things are always take longer to achieve. So I think forecasting these changes on the near-term horizon and making investment allocations based on that is a risky endeavor.
Indeed. There's so many things I want to just grab and run with, but let's move on to M&A here for a second. We were talking a little bit about money flowing into the industry and deals really getting big, right? And we saw several massive deals announced this year alone. Think Tilray, Freya, and Jazz Pharmaceuticals and GW, Curaleaf and EMMAC, Trulieve and Harvest. Like, we're talking about multi-billion-dollar deals. So, like, what's going on, and how can companies prepare for this increased M&A? Emily, do you want to go first?
Yeah, I mean, it's all a part of an emerging market cycle to see how these companies build, and then there's consolidation, more building consolidation, maybe even then some separating of things that have come together. So it's an interesting time. I think we've seen waves of M&A and consolidation before, but the wave this time feels a little bit different to me. It feels a little bit more strategic. It feels like companies are coming together with a real go forward plan, and it's really happening on every scale, as you pointed out. I mean, the Trulieve Aphria transaction, but the Trulieve, wait, did I say Tilray Aphria, Trulieve Harvest transaction, the Trulieve Harvest transaction, it was it's definitely something that, Kim really leaned in on. I think it was smart that she made a pretty bold move there and is expanding her footprint meaningfully after really nailing it in Florida. So that's a pretty strategic M&A transaction, in my opinion. I think there's a lot of work to do there, but I think that's the nature of any M&A. And then you see everything down to smaller transactions that are going on in states like California. California has been an incredibly difficult and competitive market to operate in. And so some groups that had different theses about how the industry was going to evolve out there have realized that you have to kind of jump into a vertical to really go forward. And so, we just saw the transaction with Besito, which is one of my, I mean, I'm right in the square of that demographic of that company. I love that brand. I think it's a great LA brand. And, they jumped in with Spark on a vertical, and they're both very mission driven, values driven organizations, and also just really focused on experience around brand building. So I feel like even those littler ones are really meaningful because it's showing true strategic partnerships that are coming together to drive a better experience for the consumer in the end. So I think that's beneficial.
We always thought 2021 would be, the year of corporate transactions in the boardrooms early in the year. Are we going to RTO? Are we going to IPO? Are we going to merge? Are we going to buy? What are we going to do? And I think the advice is we deal with mostly private companies in the space, smaller companies. And if you think back to, the early days of a company's life as licenses are being applied for, and we see a sort of complex hodgepodge corporate structure, usually a holdco, separate LLCs with separate owners of controlling licenses. And, the advice we'd give to these small companies is complexity is not your friend. And then in addition, I think in the green rush, late 18, early 19, we saw some aggressive and, dare I say, reckless financing. And the result was a complicated Frankenstein type capital structures with different corporate entities, different owners having encumbered various assets. And then, the thing is, we approach the space and with a view towards M&A, these are largely non-institutional operators that control hundreds of licenses across the country, and they have limited access to capital. They're lacking financial controls. They don't have institutional capital allocation processes. So, the advice that we have for small operators is keep the balance sheet clean and simple, keep the org structures clean and simple. This is a way to maximize value. And over the last couple of years, as we've deployed capital, we've really gone in and in many instances helped these companies clean up their corporate structure, clean up and simplify their balance sheets with a view towards maximizing value in a potential M&A transaction.
Yeah, definitely. I love that part about, complexity is not your friend too. It's very clear. And I've been hearing that a lot recently, right? A lot more people and smart investors, for instance, questioning how smart and viable is vertical integration for the long term, right? It was born from necessity, but a lot of investors are now questioning whether it makes sense or not. So, again, trying to reduce complexity could be a very interesting way to go for you.
But the sequencing matters there, Javier, I think also, because when you talk about, and I think a lot of people are trying to figure out what they want to be when they grow up. They want to try to see through at what the landscape looks like on the other side of interstate commerce, for instance. And, the reality, at least the way we're looking at it, is we don't know what we don't know. But we do know, as Emily has said, this business is great for a lot of these companies, at least the companies in our portfolio. And we don't know what margins are going to look like down the road when things open up. There's a lot we don't know, but we have a good sense that the states are going to continue to regulate who can grow, process, or sell cannabis. And certainly, if you're looking at cannabis as a tax revenue and jobs growth engine, they've got to feed that beast. And the existing infrastructure in oligopoly is currently providing that product. So so by the time interstate commerce actually comes through, all of these other artificial impediments through our lens are going to be gone also. And these things are going to be up and to the right, and we can make a decision on who the winners are in that new world. And I also think, just through the lens of the FDA, as long as we're talking some of the risks in the sector, again, is the FDA going to step in to stop a post-pandemic jobs engine, a post-pandemic tax revenue engine, or is it going to be carved out like alcohol and tobacco, which is our sense? So there are concerns, certainly, but this is a space that we are playing for as much as the adoption. I think John had said 2021 is the year of, and we think history is going to look at 2020 as the year U.S. cannabis was birthed, even though some of us will have the war wounds to argue otherwise. But we think 2021 and beyond is the migration, and not just the institutional migration, but certainly the societal migration, the psychological migration, the perceptional migration. One of the first things we did when we launched CB1 5 years ago was trademark. It's not about getting high, it's about getting well. And I think as more people understand that, as those clinical trials come through the research side, that's going to illuminate the consumer curve and really, get those late stage adopters into the space.
Totally. And I love that too. I often say, as you say, like, it's not just about getting high, it's about, or being high, but being well. And I often argue, well-being, mental well-being, being happy, laughing, enjoying, a good time is also a part of wellness, right? When people talk about cannabis for wellness, it's not just always therapeutic uses. Sometimes it's, disconnecting after a long conference today, right? And that is a part of being well, as you mentioned. And just a thought here. But going back to M&A, since this is an investment panel and not a philosophy panel, where do you see M&A coming from in the next few months? Do you see continued consolidation within the industry, or more external players jumping in? We've seen some tobacco players, of course, make moves. Some alcohol players make moves even already years ago. So what do you envision here? Sean, do you want to take that one?
Yeah, I think you're going to see a lot internally, because you look at, there's two kinds of acquisitions that we're seeing right now. There's the pure geographic acquisition where I want to get into Massachusetts, I want to get into Pennsylvania, wherever. And then you've got the strategic acquisition where you look at some of these companies and they're not operationally sound, so they can go and acquire somebody who is. They're not great retailers, so they can go and acquire somebody who is. And that's what we keep seeing, and what we think is going to keep happening is you look at a map, you see whose maps line up together, and you look at a company and you say, where are they weak and who can they go out and acquire to get better? At the end of the day, I think the acqui-hire strategy is going to be a lot of what's happening in kind of the smaller cannabis stuff. But big outside of that, I do think we're going to start seeing alcohol and tobacco dip their toe in, learn about the space, get their feet wet, figure out who the players are, and develop a longer term strategy. Because at the end of the day, we don't think it's viable that alcohol and tobacco are necessarily going to run cannabis farms. We think they're going to want to play different parts of the value chain, and they're going to need to figure out where exactly that is in relatively short order.
Definitely. John, anything?
Nothing else.
Anyone else? I mean,
the only thing I would add, Javier, is there are I can tell you factually, there's a lot of conversations, there's a lot of dancing going on, and it's complicated by the fact that the volatility in the marketplace is so extreme because things are moving around so much. But I agree that there's going to be a different lists of buyers. There's a natural sort of footprint synergies, and then there's going to be other industries. And again, looking at this 2.0 trade, cannabis as an ingredient. There's going to be a lot of form factors. There's going to be a lot of end products, a lot of use cases, many of which are not euphoric or not going to, if you look at the cannabis plant, there's a treasure trove of API. You have the THC that produces that high, but there's a lot more in that plant. So as we unpack this, we're going to see that across a number of different lines, and we're going to see a lot of different industries, I think, look to, step into that supply chain.
Yeah, Javier, the only thing I would add is there's still a pretty big bid-ask spread in terms of buyers and sellers and expectations. And if you're a smaller company, you really need to say, can I get access to capital in 6 or 12 months, right? You don't want to be the last piece on the chessboard, or I guess you kind of do, but you want to find a dance partner as everyone else is merging. So weighing in between, all right, do I take this price today? Do I invest? What if I miss my opportunity and miss the window? So there's it's a tough strategic game right now.
And if you'll humor me for a second here, a question for all of you here. As M&A speeds up a little bit, which side would you rather be on as a company, as a buyer or the seller? And what are the benefits for both, and how do you prepare for any of these instances?
I think that always depends on the price and the consideration you're taking, right? So it's a really tough question to answer without really digging into specific situations.
The only thing I would add, I'm sorry, Emily, please.
Oh, no, what I would say is a lot of our underwriting, when we're modeling our exits, we underwrite to an acquisition because that's usually our lower multiple, really speaking. And so, we evaluate what we think are the exit opportunities of every company we enter into, the likelihood that it IPOs versus it gets acquired, and now, we have to think about, is the acquisition coming from within, without the industry, or outside of the industry? And is it coming from a like company in an analog sector, or is it coming from a private equity firm that we might see starting to come in more and more? So there's different ways to think about it, but that's typically our lower multiple exit projection, but we feel like it's a good floor to contemplate when we're thinking about how these things can exit, and if they can get the escape velocity to have their own exit through an IPO and to be the consolidator. I'd much rather take a solid exit through an M&A transaction and mark it as a base hit than have a zombie in my portfolio for God knows how long, which we've seen a lot in the tech sector when I'm thinking about more of our VC style investing. So.
Yeah, the only thing I was going to add, Javier, is in the public side, yards after the catch to us is the metric you want to look at. Regardless if you're a buyer or a seller, it's what can you do together post close. So that's when we talk about that with a lot of companies that we talk to, it's not about just the price you're getting. It's about what are you going to look like after the transaction? What does the upside look like for the combined entity? So that's the only added value that I could add there.
Yeah. And that makes me think again, how important are, multiples really when investing in cannabis, and this is of course a matter of opinion, but I know some of you are believers on different ways that, to look at companies, like the potential return on investment and what is the exit strategy, and maybe not necessarily getting spooked by a high, sales multiple on evaluation, or a high multiple on earnings or EBITDA or whatever, right?
Yeah, I think you have to look at, to Emily's point, what are the exits? Because Massachusetts is what people keep talking about. There's very few acquirers in the state of Massachusetts left. So you can invest at the cheapest multiple possible, but you may be stuck. I think the same thing is true about what's going on in California, and the same thing is true in de novo opportunities where you'd be willing to pay a higher multiple because no MSO can get in there yet, and they will be coming. And so I think it all depends on exactly where you are in the life cycle of your business and what the competitive and legal dynamics are in that market.
Yeah, I think just throwing out, people just want to be cautious when you talk about multiples, and it's really a multiple of what. So, not too long ago, people started inventing new metrics. And when you looked at the LPs in Canada, and they were going nuts, they were trading on a market cap or a multiple of planned square footage, then funded square footage. And obviously that led up into a major crash. And the cautionary tale of the dot-com bubble in 2000, when people start valuing companies on market cap to eyeballs, et cetera. So revenue is easy and convenient, and so is EBITDA. But at the end of the day, cash flow is what really matters. And it's not just the current cash flow, but you need to use a very holistic and dynamic approach that incorporates the local market, an understanding of projected new licenses awarded, the changing legal and regulatory structure, and creating a dynamic model of supply and demand, and hence price, and forecasting out the cash flows. And then, of course, as everyone has talked about earlier on this panel, you need to think about, all right, what's it worth in the public market to investors? What's it worth to a potential acquirer? Is the acquirer from within industry or from CPG that has a much lower cost of capital? So it is really dynamic. So I tend to caution people to just shy away from static 1 or 2 year multiples of revenue or EBITDA.
Anything else in relation to this? If not, I'm talking about investing in multiples, deploying capital in the industry nowadays. Is it easier? Is it harder than it used to be? What makes it a good or bad investment climate?
The elephant in the room is the custody issue, right? I mean, we've been dealing with this for a couple of years now. Certainly the accessibility, the liquidity, and that's a double-edged sword. It's going to work the other way, as if this big box CPG company, as Sean said, comes in, or something out of left field that nobody's looking at, which typically is what happens. You're going to have a race to put on exposure, and that illiquidity is going to work the other way as well. But as long as these things are listed on the CSC and the pink sheets, I think and I'll sort of be a little bit variant. You do sort of lean against some of these multiples because you've got really good fundamentals that are getting better with continued state adoption. That's not being reflected in the stock prices, in our opinion, anyway. So when you have that that chasm between perception and reality, that's typically where profits are found, and we just think that that's going to continue to offer an opportunity until these things get uplisted. But be careful for what you wish. My friend Jason Wild always says they could pay us now or they could pay us more later. Once these things uplist, once the artificial impediments are gone and these things are fully covered and fairly valued, our jobs are going to get a lot harder. And this cottage industry of ours, where we all know each other's names, is going to be an industrial complex. Presumably everybody on this line will benefit, but it's going to be different, is my point. And that's what we're waiting for. But trying to enjoy the journey despite all the if I can say fuckery in our right now is
Don't worry.
What we have to prepare ourselves for, because who knows the timing? We just know it's going to happen. We just don't know when.
Yeah, I think that this is a great time to put money to work, because what happened is you had a flood of capital come in Q1 and it sort of stopped. So there's not these super hot raises going on, and valuations are pretty reasonable. I think over time, what you're going to see is that this vintage right now is a different class than what we've been investing in for the last few years. It's operators that haven't come up for air for a few years, or guys that are doing their first raise ever. And you're seeing just a different type of entrepreneur. Not to say it's better or worse, but it's a new opportunity set, and it's not a very competitive capital landscape. So this, to me, is an ideal time to put money to work.
Yeah.
Go ahead, Emily. Sorry.
Yeah, I'll echo that with Sean because earlier in the year, Morgan, my brother and business partner, and I, we were kind of like, it was running pretty hot, and we were like, we still want to get more chips on the table before before the big wave comes in, the big institutional wave of capital, which I do think will change things. But so we've been taking an opportunity to make sure we're continuing to grow our exposure in the sector because we do think there are some really solid companies in this space, and so I think that so it does kind of ebb and flow. I will say on the private side, one of the things because that's a space we do invest in and private kind of more venture style investing. But some of the things that make challenges for us are sometimes you get family offices or not as seasoned institutional investors who are, creating a portfolio. They're just kind of interested to get into the space. And I think there you can see distorted valuations and also kind of poor structuring of the transactions so that it's not setting the company and the investors up for success when there are these future rounds. That makes it a little bit difficult because as a founder, they could be very well attracted to that easier capital to get in. Whereas I think that it's really important to hold out for that strategic capital that's really thoughtful about why we're structuring it in certain ways to attract future rounds of capital and set the company up for success. That's when we start to face challenges, is when there's exuberance around it, but that is not grounded in like really strategic thoughtfulness around deploying the capital into the business. And one other thing I'd say about that is that there is prudence driven by scarcity of resources, right? Like we've seen a ton of money flowing into Silicon Valley, and we've seen some of the upshots of the use of that capital and how it's been, contemplated and carried forward by the founders. I do think that having some of that scarcity makes operators a little bit sharper. And when I've seen a pile of cash go into a company and they're not prepared for it and prepared to be good shepherds of it, even if I'm on the cap table and yeah, it's great. It's like, well, okay, here we go. We're a velocity situation. I do get a little nervous because I'm like, I want to make sure we're ready to make good use of that resource, which is not available to all companies. So it's very important to us to think about the corporate governance that's lock in step with that large influx of capital.
Yeah, that's a great point.
The only thing I would add is just to the question, is it easier to invest or a good time or not? One of the comments made earlier is that the proof of concept has been answered. Like companies are generating positive cash flow and EBITDA, and debt is a very attractive financing choice for companies, right? Less dilutive than equity. And what we've seen is the capital markets for the bigger companies have opened up, going back to 2021 being a year of strategic decision. People are no longer there's a renewed sense of urgency on the part of some of the smaller private companies, and they want a credible partner. They want capital. They realize that time is money and the game is afoot. So we've seen greater demand or interest in people willing to engage and contemplate growth capital in the form of debt. So I'd say this environment has continued to improve.
Yeah, taking a little bit of what Emily and John were just saying, right? We're seeing in many senses a maturation of the industry, an end to these days of exuberance, more measured spending. And so to a certain extent, an institutionalization of the industry, is that a word? So what do you see on the institutional front, both on the operator side and on the investor side, in terms of investing, of course?
Yeah, I think on the corporate side, we've talked about some of the transactions earlier in the year, not only with Constellation and with Altria and Kronos, and people approaching it in different ways, whether it's starting in CBD like Kronos or on the THC side with Canopy. And I think you'll continue to see more and more of that. On the capital side, it's really interesting because I still feel like it's very early days. Early in my career in the late 90s, I was at Goldman and we were raising a private equity fund. And back then, we'd go to corporate pensions and the allocation towards alternatives, including private equity, was like 1 or 2%. And here we are 25 years later, and you look across the real pools of institutional capital, pensions, endowments, foundations, sovereign wealth funds, and you'll see allocations to PE and VC on the order of 10 to 20%, in some cases higher. And more recently, as we've started Focus Growth and been speaking to capital providers and investors, I have the benefit of ran a hedge fund for 16 years and have relationships across sovereign wealth, endowment, foundation, consulting landscape. And for the most part, cannabis has been, especially plant touching, has been on a no-fly list. But over the last months, I think that's beginning to change. So instead of people saying, look, we just can't do it, and not willing to listen or have any interest in being educated. I think several of the consultants and even some of the pension funds and institutional investors are starting to do some groundwork to learn about the industry. So I think this is a harbinger of things to come. I still think that we're a ways away from institutional assets really entering the space in a huge way, but the trend is certainly starting to move in that direction.
Indeed. And, we have 4 minutes left. I want to get into Cannabis 3.0. I know you are excited. So, what are you seeing there? Why are you excited about this?
You're talking to me, Javier, yes? Well, no, listen, I don't think there's anybody that has felt or been touched by the efficacy of cannabis that is any less passionate about this, and angry for that matter at what's occurred in this country over this prohibitionary period. There has been a lot of anecdotal stuff. As a matter of fact, a little plug here, and it's free, so I feel good doing this. On our website, under research, we built a repository for all the different indications that are touched by the endocannabinoid system. There's about 40. It's exciting. A lot of these are unmet medical conditions. And we think, if you follow the science, and we have 2 minutes left, so I'm not going to do that here, but if you pay attention to what's going on in the science, and as that starts to open up, I think they're going to find that cannabis has an efficacious agility across a number of different indications that's going to be very helpful for society. And I don't think society knows that yet. GW Pharma was sort of the lead punch there, but there's a lot more companies coming up behind them.
Yeah, I look at the adult use side and I say things like Can, which is a drinkable cannabis beverage. That to me is sort of where we're going. The consumers figuring out what form factor they like. New consumers are coming into the market and saying, this is what I prefer. I still think we're shaking out where vape lands in terms of what the ultimate use case is. But I think from the consumer perspective in adult use, we're finally getting to the point where people are seeking out products as opposed to just walking in and saying, I want an indica or sativa, which I think those days are coming to an end.
Yeah, no, I think form factor increases the availability, or form factor and increase availability, decrease stigma, decrease price. All these things are great for the future and the future growth and acceptability of cannabis products.
Yeah, and I'm just excited thinking generationally about there's new generations of a workforce who are creating their own wallet. And so cannabis is ingrained in their own share of wallet and thinking about where that lives in their entire consumer spectrum and their lifestyle spectrum. And I think, Javier, you made a great point, and Todd, about how feeling good is lifestyle, it's wellness, it's pharma, it's all of those things. Cannabis lives across that whole spectrum. And so it's just really interesting to see how there's all of those different ways that people can participate in this category. And, my friend and one of our companies, Cy Scott from Headset, he calls it cannabis packaged goods. And I think that that's, it's what it is. And I think it's exciting to see that recognition, seeing cannabis being grouped in with consumer, and for us to really think about it. And then you're seeing on more of the global level, really this bifurcation where there is like a very pharma medical focused industry being built along the rails of EU GMP certification. And I think there's a lot to that as well, because at some point this will all converge, and then we're just going to have a massive global industry. And, by then maybe, I'll be retired because I'll be old. No, I'm just kidding. But, in dog years of
or
cannabis,
rich. Let's hope you're retired because you're rich.
But
that's what it's about.
And we're on the right side of history, which I think is going to matter for our kids and our grandkids when they look back and they say, tell us about Grandpa Todd. And they go, well, he was early, but he was ultimately right. He wasn't around to see it, but he was there.
We're a little crankier for it, but having the ability to sit at the ringside seats to watch an industry being built globally is pretty incredible, and knowing that you contributed to it.
Indeed. And we have time. I think I can squeeze in one question from the chat. There's a bunch of very good questions from Sebastian. I want to pass along one that I think we can do like a quick fire from JT. Chances of federal legalization in 2021. Let's say 0 to 10, and 10 seconds for a why. Emily.
Like 2. I'm not a bull on this one. I think there's a lot in the way, but.
Yeah, I'd say 0. It's a complicated decision, and
Yeah, I'm in and around where they are. Federal legalization is going to take time, but I think you're going to see incremental legislation on the federal side this year potentially. So
Yeah, I agree.
I'm with the group, zero.
And I think most importantly, just for everyone to think about, implementation at the state level takes 1 to 2 years. It's a complicated process. So even if we got it, we all have to be ready for that delta between legalization and implementation. So just for everyone to keep in mind.
yeah, well, look at New York, right? For example, that's going to be a monster, but
Yeah.
it's going to take time. They got to build it out. So it's exciting though. Just be
It is
patient.
exciting. Yeah.
It is exciting. And yeah, I'll have to concur with all of you, probably 1 or 2. I mean, let's hope,
never
positive
know.
thinking. Let's put some of that into the world.
Ever
Maybe
the optimist, Javier. Ever the optimist.
So I think these are, a wrap for us. Emily, Sean, Todd, John, thank you so much for joining us. This was illuminating, educational. And for anyone watching, please reach out. If you have any questions, we'll make sure to pass them along to these great panelists.
Great
Thanks,
job,
Rob.
everyone. It's
Thank
great
you.
to see you, each of you. Shout out to Todd's dog, too, who is literally the best associate ever. Look at that.
There was a great comment about
Literally
the
has
starting
not moved.
420 early.
That is impressive. That is impressive. Great to see all of you. Thank you very much.
Thank you.